Good morning, everyone, and welcome to today's OHBA members webinar. For those that I have not yet had a chance to meet, my name is Scott Anderson, and I'm the CEO of the Ontario Home Builders Association. This is, as you know, our second offering of this, and I'm very keen and excited to be part of delivering yet again another member promoted webinar on such a topical issue as we have today. As I said, this is our second one in the series with Canadian Mortgage and Housing Corporation. Just a couple of housekeeping items before we get started. If you have questions during the session today, just please submit them into the Q&A function, and we'll be able to address those. And this session will also be made available on demand for viewing by OHBA members at ohba.ca later this week. And if you missed last month's webinar of the new home construction and rental housing market trends, this is also available for on-demand viewing on ohba.ca. So now on to today's session. On May the 1st, CMHC released their 2024 Housing Market Outlook report, which explores the latest trends in Canada's housing market for new homes, resales, and rentals. Today, we're pleased to welcome back Anthony Passarelli, the lead economist, Market Insights with CMHC. And he will take us through this report with an Ontario lens. So Anthony, thanks for joining us today, and over to you.
Thanks, Scott. Appreciate it. Great to be back for another webinar. Really happy to have this audience for data. Today, if you were at the previous one, I went over essentially what happened in the new home market in the first quarter of the year, and I recapped our rental market data as well. So today is a little bit different. We put out our forecast, as Scott mentioned. So I'm going to go through our housing market outlook for the next 2 years, and it covers the major markets in Ontario that we put out a forecast for: Toronto, Ottawa, Hamilton, Kitchener, London, Windsor, St. Catharines, Niagara. So I'll be getting into some detail about those markets. And I'm also going to touch on not only the outlook for the new home market, but also the rental one, because it has some, it ties into some of the construction trends we've seen lately that I mentioned in the previous webinar. So I'll get right into it. Excited to hear your questions at the end as well. Before we get into the actual forecast, we always have to go through what we would call our baseline assumptions that feed into the numbers that we project. So a couple main things that we look at when we consider what are the main assumptions on the forecast. The first is the mortgage rate outlook. The mortgage rate forecast is something that's the most in demand or talked about right now, obviously, given where rates are high from a recent historical perspective, at least. Our forecast for mortgage rates is pretty similar to the consensus out there, which is we're going to start to see some relief in terms of lower mortgage rates starting in the second half of this year, going through into next year. So that's going to help to spur some demand, particularly on the home ownership end, as we've seen a lopsided amount of demand going towards rental in the last couple of years. Here I'm just showing you some background of our mortgage rate forecast. The story is the inflation will start to return to that target 2-3% range, and then the Bank of Canada will be able to cut rates. Inflation data has started to show some signs of softening back to that range. So again, our baseline is for that mortgage rate cuts to start in the second half of this year. There are alternative scenarios that we have out there that might see inflation stay higher for longer, and that would push the rate cuts further, potentially into next year. But in terms of the baseline assumption that I'll talk about with the forecast, this is what we're expecting to happen, which is, rate cuts to start in the second half. Other baseline assumption is around the state of the economy. So we talked about the mortgage rate story. Now let's talk about the economic story at a more national level. This year, we do expect it to be a slower year in terms of economic growth. Baseline scenario is for very little to no growth. There are scenarios that could see the growth go negative, depending on, again, the interest rate story. But we do things are going to improve from here. So this year is kind of a low point for the economy when we look at the next couple of years. Here I'm just showing the GDP growth, real GDP growth, I should say, on a national level. That's the baseline forecast that we have put out. You can see that, you know, in 2024, we do expect it to be around 0% growth, and there will be some bounce back in 2025. A lot of that is predicated on the interest rate story. Again, consumer spending has made up a big chunk of the economy, right? The spending out there, and it's particularly in 21 and 2022. So with those rates expected to start to trend down, that will free up some spending power from consumers and help to bolster the economy over the next couple of years. So again, that outlook for the GDP growth is heavily predicated on what happens with the Bank of Canada and interest rates. And the third main sort of macro factor that we would look at in terms of having an assumption for when doing a forecast is on the population growth story. So we do expect this to continue to be a strong population growth in the next couple of years, particularly due to the immigration side. So on a Canada-wide level, which is what you're showing here, is the immigration numbers. Now, this is just the permanent residents that have been admitted to Canada, not including the non-permanent side, which I'll get into in a little more detail when we talk about the rental market forecast. But sticking to the permanent resident admissions in Canada, you can see the numbers have been trending up, particularly after that COVID year where there were travel restrictions. And if you look at those three red bars, which are the federal government targets for immigration, their targets are for immigration to be at similar to higher levels than we see even last year when they were at record numbers. So that strong population growth story is going to continue here. It's going to put a lot of pressure on housing demand, whether that be on the rental side, which a lot of new immigrants go towards, but also on the home ownership side as well, because we've seen this recent wave in the last couple of years of high immigration, and some of those will start to move into the home ownership market, particularly when mortgage rates start to decline. So let's get into the actual outlook for the new home market. So those are sort of baseline assumptions. Mortgage rates starting to trend down the second half of the year. We have the economy, kind of a weak point this year, starting to trend up next year with lower rates, and the high immigration continuing to put a lot of pressure on housing markets, new and ownership, because again, there was a lot of immigrants that came in recent years that might shift into home ownership in 2024, 2025. So on the new home market story, we do expect the general overall picture for the province is that depending on the center that you're involved in, you know, if you're building a lot of apartments, you're probably going to see a slowdown this year and into next year. And I'll get into some of the regional breakdowns in a sec. Starting with last year, so just a quick recap. Last year, we did see construction slow down. Now at CMHC, when we forecast the new home market, we're focusing on the housing starts number. And that number, if you don't recall, is essentially we have people that drive around to construction sites based on building permit info and check if the home has reached that foundation stage. So a housing start is when a home's hit that foundation stage. So 2023, that number did drop in Ontario. However, it was coming off of a near record high. 2021 and 2022 were very strong years for construction in Ontario. The number did drop 7%, but it was still a very high number historically. I believe it was in the top 5 in the last 20 years. So it was still a very strong year for construction last year in Ontario. If you break down the housing starts in Ontario by what we would call low rise. And again, when we're saying low rise, we're talking about single detached, semi and row in one bucket. And then we're separating apartments. Clear storyline that developed last year was that the single detached, semi and row bucket, which we would call low rise, that was at a 10-year low. And I'm showing that there on the left. That's sort of the range of annual starts for those types of houses. 2023 was a 10-year low. On the opposite end, and on the apartment side, the apartment starts were at a 10-year high last year. So the market's really sort of diverged. Single detached, semi and row, 10-year low, apartments at the 10-year high. Getting into some of the factors that affected that. So if you look at the markets, and these are the ones that we cover in the forecast, I mentioned at the beginning. So we have Ottawa, Toronto, Hamilton, St. Catharines, Niagara, Windsor, London, and Kitchener, Cambridge, Waterloo, which I shortened to KCW there. Last year's numbers, you can see that generally markets like Toronto, Hamilton, and Kitchener, they held up their starts better than these other markets. And the main reason was that these are the markets where apartments make up a bigger share of the construction activity. The drop off in the other markets like Ottawa, London, Windsor, and St. Catharines, Niagara, that was a lot to do with the fact that they build more of that low-rise product, which responds a lot faster to the changes in mortgage rates, whereas the apartment product is a little slower to respond to mortgage rates. And I'll get into some details why. So this kind of continues from what I just mentioned in terms of last year in these markets, and the fact that here I'm giving you a more specific breakdown of in the last 5 years, how many of the housing starts in each of these areas were in the single detached, semi and row bucket versus the apartment bucket. And you can clearly see that, a market like Toronto stands out obviously as being about 3/4 of the activity is in the apartment space. Whereas in St. Catharines, Niagara, it's the opposite, right? So generally the markets that had more of their construction activity concentrated in apartments, the housing starts last year held up a bit better. Again, heavily tied to the mortgage rate increases in the last few years, still haven't necessarily played out into the construction yet in the apartment space where it already did in the single detached, semi and row, because those housing starts are quite quickly respond to the decrease in demand from lower sales, whereas the apartments are on a whole different timeline generally. Reason for that, main reason is when we do a housing start, to get to that foundation stage for an apartment generally takes quite a long time, right? It could be up to a year depending on how big the project is. So the activity doesn't necessarily reflect what's happening currently in the market. It's usually going back a year or two. And in case of Toronto, even more than that, in terms of that construction activity. So that's why last year you saw sort of two different storylines. If you're in the low-rise space more, you generally had a slow year. If you're in the high-rise apartment space, you had a pretty good year. Didn't see either you had a bigger year than the year before, or things kind of leveled off for you. That's going to change next year, which is a big part of our forecast. So that apartment story, which I just mentioned, the mortgage rates increasing in recent years are really going to be more reflected in the apartment activity this year and even next year as well. Particularly in that condo space is where the big change is going to happen to us. We know that the launches of the projects since the mortgage rates have been there are a lot fewer of them. The sales have been slow, and a lot of that is tied to the investor demand. We know that there's been a number of reports put out about the investor activity is lower because, based on where mortgage rates are, condo investors are in a cash flow negative position more than they've been historically. They've been in the cash flow negative position for quite some time in a lot of markets, particularly in Toronto, but it's gone to a much deeper negative position now that mortgage rates have gone up. And it's going to be more reflected in low sales of new condo projects, fewer launches, and a lot of that's going to be showing in data probably later this year, particularly next year. We think is going to be that low point in terms of housing starts, because a lot of there's just going to be a lot fewer condo projects out there. And on the rental side, the mortgage rate hikes have obviously made fewer projects viable as well. And there is some delay in that space as well. Rental projects, because they're apartments, they don't necessarily show up. The starts activity doesn't reflect what happened currently in the market. It's usually a few years back because of the time it takes to start the construction on it and also the approval times for apartment projects as well. So let's get into the actual forecast. So that was a lot of what happened last year and that storyline that developed of if you're building more in the apartment space, like in Toronto, Hamilton, Kitchener, your housing starts last year were still pretty good. And in the other markets, they were down a lot. Here I'm showing you our actual forecast, and that's in that teal color. We put out a range for what's going to happen in terms of housing starts activity this year and next year. This is showing this year's number, and I'm comparing that to where housing starts are now. So I used a 12-month rolling total of housing starts. So basically what's happened in the last 12 months in these markets is in the purple, ending in March. And our forecast is what's showing there in teal. And if you look at those markets with the apartment concentration being higher, like Kitchener, Toronto, and Hamilton, that purple number is higher than where we think things are going to end up by the end of the year for the most part. So we do expect activity to decelerate, trend down in those markets because a lot of it's tied to, again, their apartment construction, particularly on the condo side is where we're going to see the most amount of weakness. You look at the rest of the markets that we forecast, like Ottawa, London, Windsor, St. Catharines, Niagara, and Hamilton, or sorry, not Hamilton, St. Catharines, Niagara, that purple number, which is where housing starts are currently over the past 12 months, we generally see things picking up in those markets. They've sort of already hit the low point, particularly last year. A lot of them had multi-decade low starts in the single detached space and even in some cases in the row townhouse space. So we do expect that to pick up in these markets. They're a little faster to react to those lower mortgage rates that'll start to happen. This year might be where things start to slowly creep back up from the low, and next year things should be a bit higher. And I'm going to get into some storylines for each market over the next few slides, but generally that's the storyline. Currently, where housing starts are, we think things are going to decelerate in those markets with apartment construction, Toronto, Hamilton, Kitchener, and potentially accelerate a bit in the rest of them because they rely more on the low-rise products. So let's get into Toronto a bit. This is taken from our forecast report, which I put a link to at the end of the presentation. And again, these are the ranges that we put out. And I showed you the 2024 one already for Toronto. We broke it down by single detached and multiple. I'll focus more on the total number, but we're showing historical data next to the ranges for the next 2 years. The main thing in Toronto, again, is that condo story. The condo investor has really gone to the sidelines since rate hikes have gone up. And again, the housing starts activity is really tied to project launches, particularly next year, project launches that happened after the rate hikes occurred. A lot of that activity in even last year and early this year have been still tied to that pre-rate hike project launches. Now a lot of those have already started, and we're left with a lot lower numbers after that point. And this kind of shows like in detail what I'm talking about. This comes from Altus. They collect the data on the new home sales side. Pulled this from their latest report, which looked at the first 3 months of this year. The bottom graph is the sales activity in the condominium space. And you can clearly see how the levels were so much higher in 2020, 2021, 2022. Now, a lot of those sales and the projects tied to those sales have already started now in Toronto. There were still some that started late last year and even early this year because the activity's been very good early in 2024. But we don't think there's going to be many more of those left, particularly as we move into later in this year. And you can see how the sales activity has dropped off significantly in 2023 and 2024. So that the numbers next year in terms of starts activity are going to be more reflective of what happened after rate hikes occurred, which is a significant drop off, which is why in Toronto that starts forecast range was very low next year. So this year, things will slow down, but historically will be fairly high. And we think next year is really, really going to see the effects of that low activity. The chart on the top is the single family sales activity. You can see that things are starting to tick up again, still very low, but starting to tick up. Again, the single family market responds much faster in terms of starts to these sales. So you'll start to see the effects of a little bit of a pickup in the sales activity later this year. Let's move on to Ottawa. So in Ottawa, again, they do build quite, a little bit less than 50% are apartments, but there is a still big concentration in the low-rise product, like the single semis in towns. So in Ottawa, we do expect, again, that rebound to start to happen this year. We've already seen early in the year, it's been quite strong on the townhouse side of things. And we do expect, again, the other low-rise product to start to rebound later in the year, and again, pick up into next year. So upward trending from this point in a market like Ottawa. Even on the apartment side, the apartment space is a little bit more on the rental than on condominium in Ottawa compared to Toronto. So the apartment construction in the rental space might start to rebound a bit faster, I think, than the condo side. A little bit faster response to the rate changes. The condo space is going to take the longest because the project launches have to happen. Then you have to see the sales hit those certain numbers to secure financing. So I think generally if you're in the condo space a little bit more on the apartment side, your market's going to be a little bit slower to recover. Kitchener, Cambridge, Waterloo. Last year, you're coming off of a record number of apartment starts, particularly in the rental side. And you've seen very high levels of construction. If you look at the last 3 years of history there on that graphic, these are very high levels of construction in this market. So we do think things are going to drop off again. A combination of there's a lot of rental already under construction. Generally, some developers are going to wait to see how that product is leased up. So it has to be finished, leased up to see what the kind of demand is out there before they necessarily ramp up construction on new rental. Also, the condominium space here, the investor component is quite big. We've definitely heard from people in the community that has really dried up again when rate hikes occurred. There are many projects that haven't started that were launched before the rate hikes. So there's a big slowdown coming on the condo side, which is why we see the starts slowing down here. Hamilton, similar story. Even more than a market like Kitchener or Ottawa, the apartment side of things is more a condo story, at least recently. And again, that condo demand has slowed down considerably. There's not a lot of new project launches. The ones that are launched, the sales are slow. That's going to push some of the housing starts potentially out into maybe next year. There's still a few that will likely start this year that are remnants of that pre-rate hike sales activity. But again, big slowdown based on the condo demand being quite weak and there being few project launches. I do see a lot of rental in the pipeline in Hamilton, not necessarily stuff that will start this year, but potentially starting in next year and after that. Again, not at the building permit stage, more in the approval pipeline stage. So in Hamilton, expect the apartment construction to lean more towards rental in the next couple of years. In London, the big story last year was the single detached market was at a multi-decade low. It dried up considerably when rate hikes occurred and that slowdown of migration of people from GTA markets. That was a big source of the new single detached home demand given the high price point. So we do think things are going to slowly recover from that low. We don't think things are going to get any lower than that. There does exist a fair amount of unsold new single detached homes that are ready already. So these quick close new single detached homes in London, there's a good amount of inventory to be bought. So that will sort of deter too many pre-construction sales and starts. But we do think things are going to recover. Again, with the mortgage rate starting to trend down, sales activity, which we showed you in Toronto, is already starting to pick up. It's going to continue to pick up in all markets in the low-rise space. So single detached new homes in London will start to return back to historical averages because there's going to be demand from people moving from more expensive markets, particularly when rates go down. St. Catharines, Niagara, again, of all the markets that we cover, I showed you in that graph with the percentage distribution of low-rise versus apartment, that this market tends to have the largest concentration in the single, semis, and rows. So again, last year was the first year in 4 where they didn't hit 1,000 single detached starts. So we do think things are likely to bottom out and start to pick up from this point. Again, lower mortgage rates translate into more starts pretty quickly in the low-rise space. The apartment side should soften considerably. In St. Catharines, Niagara, there hasn't been that much rental construction. It's more on the condo side. When we say rental construction, we're referring to the purpose-built rental, just to be clear on that. So in St. Catharines, Niagara, it's more, when they build apartments, it's more on the condo side, which is a little bit different than other markets like Kitchener, London, Ottawa, which does build a fair amount of the purpose-built rental. So that should suffer a bit, the condo side in Niagara. There's not a lot of project launches again, but the low-rise market is where most of the activity occurs, and that should start to trend up. And finally, in Windsor, the vacancy rate's been quite low, less than 2% for the last few years. We do see the rental starts have been pretty strong there historically in the last few years. That should continue into the next few years. There's a lot of migration into the area, given some of these projects that are happening, attracting either temporary foreign workers or workers from other regions. And a lot of them tend to rent. Also, that low-rise market took a big hit last year, reflecting the higher mortgage rates, and they should start to come out of that slowly this year. So that's the new home market outlook. I'm going to go through the rental market outlook as well. I included this as well because it does tie into the home building story. A lot of it's on the supply side. Our outlook is heavily focused on what's happening currently within the under construction side in rental. So on the last year's numbers, just to quickly recap, across the country we saw low vacancy rates, strong rent growth, and I talked about this in the previous webinar. And this was across the entire country. Typically, this was a storyline only in markets like Ontario and BC, and it sort of has spread across the country in recent years based on the affordability crunch tied to higher mortgage rates. So that strong rent growth, low vacancy rate story should continue into the next couple of years, but we do think things are going to creep a little bit higher in terms of vacancies. Here I'm just showing you the forecast for this year on the vacancy rate side. Generally, these are low vacancy rates for all of these markets. In some of them, we do think things are going to trend up from this year into 2025. Still low because there's a lot of factors that are causing that to occur, which I'm going to get into, but a little bit higher than last year, which was really, I think, a sort of high point for rental demand. So when we're talking about these factors that are particularly affecting that rental market, a big one is what's happening in the construction activity, which is why I included this segment in the presentation. So that completions of rental housing should be picking up quite a bit in the next couple of years based on what's under construction. Here I'm showing you two lines, I'm sorry. This is Ontario data. And what I did is I looked at it on a per capita basis, so I could compare 1990, say, to 2023, because the population sizes are a lot different, obviously. And I'm showing you two lines. The first one in the purple is under construction rentals in Ontario, end of the year per capita. And the green one is the completions per capita for the year as well. Clear trend in that purple line. You've seen that under construction per capita has really shot up in the last couple of years in Ontario. At the same time, those completions numbers, that green line, have not shut up yet. And a lot of that has to do with historically, those lines have been pretty close to each other. But in recent years, you could see there's sort of a gap developing. And that has to do with how long it takes for these projects that are under construction to be finished. So this kind of summarizes what is happening between those two lines in the last slide. And I broke down the average length of housing construction for rentals in Ontario over 5-year periods. Actually 6-year periods over this since 2000. And what this chart is clearly showing that if you look at the high-low within each of these 6-year periods, the trend is going up, right? So generally it's taking longer to build these rental projects. You can see that in the last stretch, 2018 to 2023, you know, the low year in terms of how long it takes on average to build a rental housing, and it's mostly apartments, is sort of the high it was in the 2006 to 2011 period. So the low now is like the previous highs. So things are taking a lot longer to be completed, and that's why that under construction number is so elevated and the completions haven't responded yet. Now, because there's been so much that's been started in the last couple of years, this is a lot of those projects that are under construction are going to start to get completed in 2020, 24, and 2025, and that's going to help to give some vacancy rate relief. So that's the sort of rental supply story. We do think there's a lot of rental that could be completed in the next 2 years. It's been taking a little bit longer to be finished, and that's why the under construction number is so high. On the demand side, we're still going to see that strong international migration that feeds rental demand. I already talked at the beginning about immigration and how immigration's at record levels, and the targets are suggesting that the numbers are going to stay at those record levels. I'm going to touch on quickly that non-permanent resident story, particularly the students, because that's a big topic right now, given the international student cap that was put in place. So here's the number of international students in Ontario annually. Highlighted a couple of years, the low in 2020, which is that travel restriction year. And you can see how things have shot up over the last couple of years in terms of international students, which is one of the reasons why that cap was put in place. So when we look at the way this cap is going to work, because we got a lot more details about it in recent months, the cap is on new permits being issued. This is total permits. So what's happening is, because the recent wave, if you look at 2022, 2023, there's a lot of international students that came in those couple of years. They're still going to be here this year and potentially next year. So even though the new student permit numbers are going to drop based on those caps, there has been a big wave that came in recently. So that, particularly this year, should probably lead to more of a stabilization in international students than a decline in them, because again, there's been a lot that came in the last couple of years and they haven't finished their programs yet. So once that wave leaves, then you might see a drop off in international students, but not necessarily this year. So we think the rental demand is going to stay strong for international students. It may not keep rising like I'm showing you here, but it doesn't necessarily going to decline. The third thing is the home ownership story. We do think, even though there will be weak outflows of renters in home ownership, that it might pick up a little bit from the ultra low levels of recent years, again, tied to the mortgage rate story. We don't think there's going to be a mass exodus of renters to buy, but it will pick up a bit. Here's a graph I like showing just to talk about pent-up demand. Basically, it's Ontario households under the age of 35 that rent. This is census data. You can see that if we look at these census periods, it's the highest percentage of renters of Ontario households under the age of 35 that rent. And this number is likely obviously gone up. The census is done every 5 years, so we don't have a more recent number, but I'm going to estimate that this number's gone up based on the mortgage rate story since 2021. So there is a lot of pent-up demand that exists for home ownership, right? you know, if you've been in the industry long enough, you remember that like in 2001, you could see the change from 2001 to 2006. That was a period where there were a lot of people that were renting that got into the market to buy, right? We don't think that's going to happen now because mortgage rates are not going to be dropping at a precipitous pace necessarily. And also where prices are at, the affordability story is a little bit different. But we do think there is some pent-up demand that will start to be released in the market. It's just not going to be maybe, again, what we saw in the early 2000s. This kind of illustrates what we're talking about with there is pent-up demand, but there's a big affordability issue that exists. Here I'm just showing you a chart which illustrates in the markets, again, some of the major markets in Ontario. If you were a renter and you had the 5% down payment, what would your mortgage payment be on a benchmark condo apartment? So this is a resale. This is like entry-level housing. How much of your income would the mortgage payment take up if you were to get into the market with minimal down entry-level housing? You can see that depending on the different income levels, generally a lot of renters are more in that $50,000 to $75,000 income range. Many of those are, you know, depending on the market, are not really able to even consider buying. So it's more of that small percentage of renters that are more in that 100,000 income and over range that could consider even getting into entry-level housing in the resale market. And it's more in certain areas where the housing is a little less expensive, like an Ottawa, a London, a Windsor, St. Catharines, Niagara, other markets like Toronto and Hamilton. This does not bode well for many of these renters getting out of rental, which puts a lot of pressure on the rental market in terms of building more supply to keep up with this high demand. And also it has a lot of trickle down impacts also on the sales activity and the ability of people to list and find buyers. So that's the outlook. This is a link. There's a link at the top there, an underlined part. When you get the presentation deck, which I'll send out after the event today, you can actually click on that underlined housing market outlook, and it'll take you straight to the report, which it looks like that picture there on the left. So that'll get into a storyline for each of the markets. It also includes the markets outside of the province that we cover. So you can take a look at that. Also, just always plugging our portal. I talked about this in the first webinar. This is where you go to get a lot of the data we collect, rental and the new construction data. This is where you can find it, and it's a very popular tool amongst the development community because you can really drill down within regions to find out where the housing activity is happening. So that's it for me. This is my contact info. Be happy to hear from you in terms of the presentation, other data needs that you have, whether you want someone like myself to present for some of your local groups as well. That's something that we do. Happy to take questions now if there are any. Let's see if there's anything in the chat box. Just going to quickly look here in terms of questions. I see one question that was submitted a few minutes ago about interest rates. So what if the interest rates don't go down? So that would be an alternative scenario, which is something we get into more detail in the report. I presented you sort of what our baseline outlook was, which is the rates start to trend down in the second half of this year into next year. If the rates don't go down, and I'm assuming you mean probably this year, then obviously all that activity is going to get pushed, right? You're going to see the low rise, which again low rise starts, which responds faster to mortgage rate changes. Instead of things bottoming out sort of early this year and moving up, you might see things continue to be weak this year and things only start to pick up next year. And then similarly in the condo apartment side of housing starts, that weak sales is going to get pushed out even further. You might see very weak starts next year, and maybe 2026 things start to pick up. So that's how I think it would play out if the interest rates were to not start to increase this year, or start to decrease this year, I should say. Doesn't look like I see any other questions in the chat box. But you're feel free to also come on if you want to ask a question live. It's be happy to take any of your questions. We have some time. Okay, let's see another question. Copy of the presentation. Absolutely. Yeah, I just mentioned that I'll be sending out a copy of this PDF, which you'll get. And also you'll also, I believe last time you recorded this and posted it on your website. So you'll have a copy of the presentation plus a copy of this recording. Another question here. Do you see any impacts from federal funding increasing response? We do. I don't necessarily think it's going to be an instantaneous response. Now we do, like, I'm assuming one of the main things is that the federal government has increased the amount of money we're dedicating to that rental financing construction that CMHC is the lender for. That's definitely a very positive outlook that we're very happy about. We're going to see more applications, or be able to underwrite more applications, which should help rental supply increase. But in the very immediate term, I'm not so sure that's going to translate into a start. Again, the main reason is it takes a while to go through the application. Even if you were to fast track it, the construction of it takes a little bit of time. So you might see that show in the data more in the 2025-2026 period than necessarily this year. Another question here. If you were in charge, what actions would you take to encourage new home construction? Well, that's a very loaded question. A lot of the recent policy changes at all of government have been very good and positive. I think they've listened to the industry pretty well. One thing that we do at CMHC in my job is I've done local focus groups with developers in certain regions that we cover more proactively. So some of the markets that I showed you in the presentation, we do some local outreach with developers, and I've done these focus groups. And one thing that's really come out that hasn't been done yet from your end is obviously the development charges and taxes, right? Like if you were to reduce those softer costs, that can help with the prices, and that will help obviously increase affordability. Like that's something that we've heard loud and clear, and I've been filtering those sorts of comments back up through CMHC, and it goes up to the minister. So in addition to what's already happened, a lot of rental focused policies, I think we're on our way. It's just that with a lot of the recent changes, getting supply to the market does take time. So anything that could speed up the actual processing of whether it's an application to CMHC, whether it's an application to the municipality, I think a lot of the focus necessarily should go to that, to find ways to get things to market a lot faster. Because even if if you're able to build more and there's more in the pipeline, people really want to see results. That's the sort of thing that we've been hearing on our end. Okay, it doesn't look like there are any more questions. Like I said, if you want to jump on and say a question, you can. Otherwise, I will leave it there. And like I said, you can reach out to me at this info on the screen. I'll send you a copy of the presentation deck, and you can also look at the recording of the presentation that I think Emma's going to post on your website.
Yes, thank you so much, Anthony, for today's presentation. We really appreciate you coming in and giving this outlook to our membership. And as Anthony mentioned, the presentation and the slide deck will be available on ohba.ca later this week under our education section. So thank you again, Anthony, and to everyone today for joining. And we will see you at our next member webinar.
Thank you.